It's Thursday, October 3rd, and this is Markets Daily, hosted by me, Jen Sanasi. Today's episode is sponsored by the Stand with Crypto Alliance. Now, as you know, if you're a regular watcher, we navigate the crypto markets on this show, providing insights against the broader financial landscape. I am very excited to have eToro US investment analyst Bret Kenwell joining today's show. Bret, welcome back.
Yeah, thanks, Jen. Glad to be back.
Glad to have you back. We've talked about the retail investor beat a bunch of times on this show. The most recent one is looking at how investors are preparing for the upcoming US elections. Just level set for me here. What was the most interesting finding that you found when you looked at the survey results?
Yeah, so for those who don't know, the Retail Investor Beat Survey is a survey that we do every quarter. We poll thousands of retail investors, not necessarily eToro investors, but just retail investors in general. And we just ask them a bunch of different questions, ranging from confidence and what their fears are, and how they plan to allocate or how they are allocated. And that goes for crypto, equities, and all sorts of different assets. And so there's always like so many unique findings that come out of this. And two of the things that really stuck out to me, one was around the election, and we saw that about half of retail investors plan to adjust or have adjusted their portfolios in anticipation of the election. And the interesting part of that wasn't that half of investors were planning to do so, but it was that about 70% of respondents said yes, and that when they were in the Gen Z or millennial camp, versus only about a third of respondents who were baby boomers and older plan to adjust their portfolio. So it's a little bit, it's just, the younger investors are more willing to jostle around their portfolios and, make adjustments ahead of time. And the older investors were kind of more willing to stand pat. And, I think on one hand, that kind of speaks to maybe the older investors' experience. They know that markets tend to do pretty well. The markets are going to do what they're going to do regardless of political party or who's in the White House. And I think older investors kind of learn that. We've seen all-time highs. I mean, you go back over the presidents over the decades, and each term has generally had all-time highs. So I think older investors kind of know that, and younger investors, they're a little more active to begin with. They're usually investing on the apps, and their brokerage firms are a little easier to navigate sometimes. So I think they're more comfortable jostling around a bit.
Tell me a little bit more about that. We're talking about older investors, them having a little bit more experience, them being able to draw on events from the past, elections from the past, and they know that, regardless of what happens, the markets are going to kind of follow the same trends. They're going to do what they're going to do what they do, just like you just said. What do you think? Do you think that we're putting too much stock into how much the upcoming election may or may not affect the crypto markets?
The crypto market specifically my answer is maybe a little different, depending on which market we're talking about. So generally speaking, I would personally not be someone who changed my investment approach because of the election. While the election is a very hot debate, it's everyone's talking about it, just as it was the last several presidential elections. It might be a hot debate, but for the market, it's not necessarily a hot debate. Neither candidate is here to tank the economy. President Trump has served before. Vice President Harris is in the administration now. So in a lot of ways, the market, I think, kind of knows what to expect from both candidates. And because of that, I think, the more important drivers like earnings are still in play. And I think because of that, while it's a hot talking point, we maybe don't have as much up in the air when it comes to the equity markets. But when it comes to crypto, now it's kind of looking like both candidates are taking a more friendly approach to their plans with regulation. And for crypto investors, that's something that they want to see. They want to see the regulatory environment become more friendly. And so I think investors are excited for the outcome. They just don't know what the outcome is. And because investors crave certainty so often, regardless of what market we're talking about, I think a lot of people just want to see what the outcome of the election is, and then move forward with their allocations from there.
You mentioned the survey took a look at what folks from certain demographics, I guess, are fearful of in the markets right now. Can you unpack that a little bit for me?
Yeah,
Sure.
it was kind of interesting when we looked at that again. And there was a skew by generation, and a lot of the younger generations, Gen Z, millennial, they had still a much larger focus, less confidence around inflation and cost of living responses, whereas older generations had a larger concern for the U.S. economy in general. And I think that's probably not too surprising. Just when you kind of consider life circumstances for, someone anywhere from like teenagers to their 30s are, a lot of them are still, they're in the early parts of their life, early parts of their career, whether that's, housing and family or just sort of, um, getting things together. Whereas the older generations tend to be a little bit more stable, especially in terms of their living situations and their careers. And so it makes sense that their focus and confidence levels are different around certain aspects. And so it makes sense where maybe inflation is pinching those with the younger careers a little bit harder than some of the older generations that are a little more stable with their living situations.
You mentioned that Gen Z and millennials are adjusting their portfolios ahead of the election. What assets are young retail investors looking at?
Yeah, so the big difference there. So broadly speaking, cash has been a big favorite really all year, regardless of demographic. It's with interest rates where they are, even though they've come down lately. When we did the survey, it was before the Fed cut, so cash was a very popular holding and remains very popular from the prior quarters. But the big difference was around crypto. Not too surprising, the younger demographics skew more favorably to crypto, especially those who are adjusting or planning to adjust their portfolios around the election. Crypto was a bigger focus for our Gen Zs, for the millennials, whereas older generations, it was more equity focused, cash focused, and less emphasis on crypto, which isn't too surprising, I don't think.
Hey everyone, did you know 52 million Americans own cryptocurrencies? That's not just a number, it's a movement, economic, social, and political. Decentralized finance, blockchain, and digital currencies are more than buzzwords, they are the future. This November, it's on us to show up and step up. We need to protect crypto to ensure it continues to fuel innovation and freedom for our families and businesses. Don't let this opportunity slip by. The future of crypto is on the line. Make your voice heard this November and pledge to vote now at standwithcrypto.org/pledge. Okay, makes sense of all of this for me. We've talked about some of the findings, but what does this tell you as we head to the end of the year? Historically, the last quarter is supposed to be a good quarter for markets and crypto markets alike. We're off to a little bit of a rocky start, I would say, if we look specifically at crypto markets. How do you make sense of this? What are you expecting to see as we head into Q4?
Yeah, you're right. Seasonality wise, Q4 tends to be very good for crypto. It tends to be good for equity markets as well. We're coming into, well, maybe not coming into right now in this month, but we're coming to the period where stocks tend to perform quite well. But over the next, call it 4 to 6 weeks, we do have a lot of different events that can come up. We have earnings season starts in less than 2 weeks. We have another Fed meeting in November. We have the election in early November. We actually have two Fed meetings, another one in December. So there's still kind of a lot of different things that can really pop up here in the next few weeks that maybe can create some bumpiness and some turbulence, which I don't think would be too surprising. But when you spoke of the crypto markets, it's kind of off to a rough start. It is, but I think when you zoom out and look at the bigger picture, things still remain pretty constructive. Like Bitcoin's up more than 100% from where it was a year ago today, and that's a really large move. And when you look at how it's been trading, when you look at kind of like, again, when you zoom out, you just sort of see it chopping in this, 50 to 60, 50s and 60,000s range. I don't really see that as a bad thing. It can be kind of frustrating for investors who want to see that move, eventually hope to see that move into the six figures. But I think it's pretty healthy to see it chopping around here and sort of building that base to move higher, to eventually move higher. And the pillars are in place, I think, for bullish investors, and that goes for equities and crypto, in my opinion. It's just sort of a timing event, sort of waiting for those short-term headwinds to clear so we can focus on those longer-term catalysts.
We've mentioned stocks a few times, but we haven't actually talked about what stocks we're talking about. What stocks are you watching?
You know what? I'm actually watching tech, and I know generally that doesn't sound like a very unique perspective, but when you look at tech, it hasn't really performed that well, especially relative to the rest of the market. In Q3, tech was the 10th worst performing sector out of 11 S&P sectors. So very uninspiring action out of it over the last several months. It was flat in Q3, which doesn't sound bad, but when you consider that 9 of the other 11 sectors were up almost 6% or more in the quarter, it really shows that tech has been lagging. And specifically, when you look at the S&P and the Dow, they continue to hit new all-time highs, whereas the Nasdaq hasn't hit a new all-time high since mid-July. And when you look in tech, of course, the Magnificent Seven really dominates that group, and only one holding has made a new all-time high since mid-July, that being Meta. And so I'm kind of looking for tech to come back into play here, come back into the picture. They still have strong earnings growth. They're still investors' favorite names. They're still household names. So I'm looking at that group. And if we go back to the RIB survey, we actually asked specifically about the Magnificent Seven holdings and which specific holdings are investors' favorites. Their answer across the board, regardless of generation, was Amazon. So I'd like to see Amazon and tech make a comeback in Q4.
Now, I want to just draw on your experience, maybe outside of the survey, when you look at the markets. We talked about what the folks who answered the survey were fearful of. Is there anything that you see as a challenge coming up, or is there anything that makes you, think twice, or makes you a little bit fearful or worried about what might happen in a specific sector of the market?
Yeah, you know what? I think we have really quickly gone from worrying almost exclusively about inflation to now really worrying about the labor market. And I think that's the right concern. Roughly 70% of the US GDP is driven by consumer spending, and we need jobs to keep the spending up. So if there is a breakdown, and there has been some softness in the jobs market, but I'm pretty hesitant to go on a limb and say it's been outright weakness. We still have jobs growth. We have seen an uptick in the unemployment rate. But generally, I think there's explanations for why the labor market softened a little bit, and a great explanation is an influx of new workers, absorbing some of that supply and raising that unemployment rate. But that would be my top concern, is the labor market. We're not at a point at this moment where it looks to be deteriorating at too rapid of a rate, but it is softening, and I think that's a concern we have to keep an eye on. I think that's what the Fed's watching, and was a big catalyst for why they ended up cutting 50 basis points instead of 25 a month ago. So I think for me, that's the biggest concern, is jobs market.
You mentioned the two Fed meetings coming up. What do you expect to see?
I think a lot of the Fed meeting, the next one is November 7th. It's in about a little over a month. I think a lot of that's going to be, a lot of the focus is going to be on the jobs reports that we get going into that meeting, and determining whether we get 50 or 25. For me, my sort of thought process would be that the Fed cut 50 to begin with, and it would make sense to go, 25 and 25 at the next two meetings. The Fed said at the moment, they're planning on, equivalent of 4 cuts, 100 basis points of cuts by year end. And so, 50 and then 25 and 25 will get us there. There's debate about whether they'll go 50 at the November meeting. I guess if the labor reports are soft, and raise a concern, especially the one that comes out tomorrow and Friday, that would be a reason to possibly go with 50 again. But yeah, I think 25 and 25 would be a great way to end the year.
I think so too. The last thing I want to ask you, Bret, yesterday on the show, we spoke about Bitcoin's reaction to the tension in the Middle East. Recently, we spoke about stimulus in China. If we zoom out and look outside of the United States, what are you watching, and how might it affect the markets as we head into Q4?
Well, the stimulus measures out of China is another great example of seeing central banks easing their policies really across the board, whether that's the Fed, the ECB. Now China's loosening things up. Generally speaking, that's good for risk assets. It's good for equities. It's good for crypto. The lower the rates, the looser the financial policies, the better it tends to be for those assets. So I think generally speaking, as long as global economies hold up, I don't think there's really a reason to be necessarily that bearish on crypto, especially when you're looking at some of the larger, like when you look at Bitcoin. To me, it has the pillars in place to continue higher. Now, I don't know when that move will come, but just like equities, I do think that the longer term path remains higher.
Bret, thank you so much for joining Markets Daily today. As always, it's been a pleasure, and we hope to have you back on the show soon.
Yeah, I can't wait. Thanks so much.
Awesome. And thank you to all of our watchers and listeners. If you like listening to Markets Daily or any of our other CoinDesk podcasts, subscribe to the CoinDesk Podcast Network. That is available on all podcast platforms. We are also on YouTube. If you like to watch, subscribe to our YouTube channel. Give us a thumbs up. As always, it's been such a pleasure going on this journey to learn more about the crypto markets. We hope you have a great weekend, and we'll see you on Monday.